Most loan applications are denied for completely controllable reasons. I mean, things that you could easily fix in order to get approved. No, it's not your revenue. It's not your credit score. It's not even your time in business. A lot of the things that entrepreneurs think is getting them denied for financing, it's not those things at all. As a matter of fact, it is the most basic of elements that actually account for the vast majority of denials. And today, I'm going to help you fix all that. It's called the Funding Ready Framework, and this is what lenders use. It's the 5-step formula they use to evaluate whether you should even be looked at as an actual applicant. As a matter of fact, these are called pre-denials. And what happens in this case is that your application is not even looked at. Their computer system is looking at this information and then denying the application before you are ever even submitted to an underwriter. You're never sent anybody for your application to even be reviewed. You're just shut down at this phase. So there's 5 different parts of the Funding Ready Framework, and I'm going to map them out for you right now with action items on exactly what to know, what to do, and what to improve. Now, the first is called configuration, and configuration really has to do with how your business is actually set up. How is it configured initially? For example, what is your business structure? Lenders prefer to see an LLC or a corporation. They do not want you to have an entity type like a sole proprietorship. If you do, in a lot of cases, that just gets you auto declined. Now, the second is, how is your identity set up? Meaning that, is your business identity set up? Do you have an identity online? Can your business be located? Can it be found online? They want to make sure that you actually have an identity out in the world to know that your business is legitimate. It makes sense if we think about it. Businesses that are not established are not going to have an identity online, whereas businesses that are established absolutely do. Next, what is your risk? What is your industry risk? What is your NAICS code? A NAICS code is like the code that identifies the industry that you're really in. You should know what your NAICS code is. You should know the exact number, and you should know the exact title of the NAICS code. Otherwise, you're seen as being in an industry that you're not actually in. And in a lot of cases, that gets an auto decline because you're not seen as an industry that the lender actually wants to lend to. Next is there consistency across your records? When they look at your offline records, your online records, your address, your phone number, your business, the name, every way that everything is set up, is it congruent? Is it consistent? This is very, very important. The majority of applications are denied because the lender's computers think it's fraud, because when they try to validate what they see on the application, they can't, because the information is mismatched online. Believe it or not, that's the number one part of the Funding Ready Framework that gets businesses designed, is this unconfiguration, or these configuration where it's done incorrectly because the business isn't consistent online. Next, do you have a physical operation that you run your business out of? Do you have a physical location? Do you have a retail address? Do you have a commercial address? If you don't, you want to use like a virtual office, like a Regus, Alliance, or a DaVinci. What you don't want to do is you don't want to use a PO box. You don't want to use an iPostal type of box, what's called a digital mailbox. You want to use what looks to be like a real physical address, even if you don't have one. And next, what are the time signals of the business? How long has the business been in operation for? The longer that a business has been in operation for, the easier it is for you to oftentimes get approved. So that really is configuration. It's one of the 5 C's of what we look at in the Funding Ready Framework. Now let's go to C number 2, and it is credibility. So credibility is like, how credible does your business look? So in credibility, what we're looking at is, first of all, how is your online presence? How is your digital footprint? Can you be seen on multiple different locations online? Are you in kind of directories that are there? Do you have social media pages set up? Like when I Google your business, what is the digital footprint of your business? An established business has a big digital footprint, and when it's not established, just simply doesn't. Next, what does your professional communication channels look like? Are you using a Gmail address, or are you using a professional address that's congruent with your domain? Like, that's one of the things that lenders want to see. They don't want to see little mistakes like you're using a Gmail as your primary email address for the business. Next, are you listed online? Like, do you have a Google business profile? For example, there's several places you can have real estate like that cost you no money, but not having them makes you not look credible. And by having them, you look credible. So you need to actually have your business listings online, any place that you can list the business, especially Google, for a Google business profile. Next, what are the public trust signals? Reviews. Like, do you have reviews, and are they positive? Believe it or not, it blows my mind that how negative reviews affect you more than you ever think that they will. It's not just in the case of getting customers. It's the case of getting lenders, investors, and so many others who may invest in your business. You need to have reviews, and they need to be good reviews. And again, If we're looking at all of the data, is that data consistent? That also ties into the credibility aspect of when we're looking at the funding ready framework. Now, next we look at creditworthiness. And creditworthiness is we're looking, first of all, at your business, your consumer credit, and the credit reports you don't even know about. When we talk about creditworthiness, one, how is your consumer credit? How is it? In a lot of cases, it does tie into your ability to get approved depending on the kind of financing you're looking at. And it's not just your credit scores, it's are you over leveraged? This is why you want to use business credit to be able to pay your expenses, not personal credit cards, because over leverage can hurt you. How many inquiries do you have from major banks? That's a factor there as well. And of course, if you do have negative items or collections, are they from like major accounts or are they medical? Like there's a big difference between those. Business credit, you have business credit profiles established. How are you trying to borrow money for your business if your business credit profile doesn't even exist? Your business credit profile is what tells lenders that you have the ability to be able to pay your bills as a business. Matter of fact, I just had somebody on my podcast yesterday that was talking about how they're giving $750,000 approvals to businesses because they have business credit profiles versus businesses that don't. It's a big deal. You need to make sure you have those established. And your bank accounts need to be managed the right way as well. The why this matters when it comes to actual credit worthiness is that you have secret bank credit scores, multiple of them, including your bank rating and check systems that banks are looking at before they lend you money. They want to know how you're managing that banking history, so it becomes very, very, very important. And also alternative risk databases too, like LexisNexis. You need to make sure that your reports there are clean because those are the reports that lenders are actually really, really looking at. So are you managing your credit responsibly? Are you disciplined? That is one of the core components of being funding ready. Now we look at capacity. Okay, now how much can you borrow? Everybody messes this up. Everybody's out there trying to get the most money they can get. That's not what lenders want to see. They want to see you're responsible. They want to see you know how much you can manage, that you're getting only what you can manage, and you're using the money for specific purposes. So is your revenue stable? They want to look, do you have regular money going through the bank accounts? Is it coming from multitude of different sources or just one? They want to see you have a positive ending bank balance, that you're not overdrawing the bank account. It's why they're asking for bank statements. How is your cash flow health? Do you have more money going in the account than going out? Okay, that's what really they're looking for when it comes to cash flow. Do you have existing debt load that means you can't support your debt? Meaning, do you have money left over every month? If you don't have enough money in the bank account at the end of each month to pay a loan, then nobody's going to want to lend you more money. And again, how is your documentation of this? Do you have tax returns? Do you have balance sheets? Do you have P&Ls? Do you have bank statements? Do you have merchant statements? Look, sometimes they're going to need some of that, sometimes they're not. But the reality is you should have your documents clean before you go apply, because how you manage those documents ties in to the capacity from a lender's perspective that you can actually operate the business. And what's your operational scalability? Meaning that, are you growing now? Is this money going to help you grow? How is this money going to help you grow? And do you have the capacity to borrow this and then use it in a way that you actually help the business grow? This all comes into that capacity aspect of the funding readiness framework. And the last C is capital leverage. And this really comes down to you choosing the right kind of funding. Okay, if you have cash flow, go apply for cash flow financing. If you have good credit, go look at credit line hybrid that's based on good credit. If you have collateral or assets, go look at that type of financing instead. So what we want to do here is we want to make sure that we are actually looking for the right kind of financing for our business, that we're sequencing funding. What it means is that we're going to apply for multiple different funding. We want to be doing it in a particular order, which I oftentimes talk about on places like here, of the right order that you actually want to apply for, okay? And again, if you don't do this, then it's adversely impacting your future eligibility. If I go to credit line hybrid and I apply for that first and it puts a bunch of inquiries on my credit report, then it's going to adversely affect my ability to go get a business line of credit. So I want to go get a business line of credit first before I look at a program like credit line hybrid. So we got to do things in a particular sequence, because that otherwise will adversely affect our impact on our actual future eligibility. So again, that's it. Those are the 5 C's. That's a very specific breakdown of the 5 C's and the 5 to 7 different components of each C that lenders are really looking at. Now you have the equivalent of like a checklist to make sure that your business is actually funding ready. And if you do that, well, then it's going to open the doors for a lot more funding for your business. So hopefully you got value from this training. And if you did, make sure you smash the like and subscribe button, and then keep your eye out for my next training, where I'm always talking about cool ways to get the money you need to start and grow your business.